Hey guys, Clint Coons here, and in this video we're going to talk about why S corporations are a horrible idea for owning rental real estate. Okay, let's get started. Okay, so maybe you've already put yourself in this position where you've set up a limited liability company and you chose to treat it as an S corporation. Or you're considering setting one up and you know that an LLC you can choose how you want it taxed, C Corp, S Corp, partnership, or disregarded entity. And you've read somewhere that you can save on taxes with an S corporation. Well, that really applies in a context where you're running an active business, not with rental real estate. You're not going to save anything when you're using an S corporation in rental real estate. In fact, you're probably going to screw yourself. And let me show you what I'm talking about. So let's assume I create a limited liability company. I have this thing set up right here, and it's taxed as an S corporation. And it holds this property. And this property has $300,000 equity inside of it. Okay, now I would like to refinance that property. So since it's residential real estate, typically what's going to happen if you're going to an underwriter, they're going to look at this and they're going to say, no, we cannot refinance that property, Mr. Coons, in the name of the limited liability company because it's residential real estate and that would require a commercial loan and it's not commercial property, blah, blah, blah. So what do they want you to do? They want you to deed the property out to yourself. So you're like, all right, that's cool. I'll deed the property out to myself. So you go down to the county recorders and you deed the property out and you put it in your own name. Now, typically with many counties, when you pull property out of an entity in which you own 100% of, or you and your spouse, whatever, however it's structured, it's a non-taxable transfer. That means the county's not going to tax you on it. The state says, that's good. You're the owner of it. But you see, the IRS, they've got a different view of this scenario. Because this is an S corporation, similar with C corporations, when you pull an asset that is appreciated, $300K in equity, out of an S corporation, that is a taxable event to you. It's treated as a sale. So as soon as you got that property in your own name, you have $300,000 in income you're going to need to report this year as if you had sold the property. I see people make this mistake all the time with their S corporations. They take them out not realizing that when you remove an appreciated asset, it's taxable to you as the shareholder of that company. Now you might be thinking, okay, Clint, I'm going to go find a portfolio lender that's going to do this deal for me. So instead, you don't pull the property out of the S corporation. You leave the property in and you find a community bank that's willing to write your cash out refi on this property. They're not going to give you $300,000. They're going to give you $150K of that $300K equity. They'll give you $150K cash to your LLC S Corp. And you're like, great. And then you turn around, you take out that $150,000 in cash, right, that you got on a loan. Now, most of us know how loans work, right? If we have property, we get a loan against that property. It's not taxable to us because we owe that money back to the bank, so we don't have to pay taxes on that. And that's the way it should work, except when you're dealing with an S corporation. So with an S corporation, when you take that $150,000 out, goes in now to tax basis and your shares and all this stuff, more likely or not, it's all going to be taxable to you. Yes, even though it's a loan, it's going to be taxable to you. So now you get hammered on the loan money as well. So I hope you understand these are the two major problems I have when we're talking about owning real estate in an entity that's treated as an S corporation. So some of you may be in this situation right here where you've set up an LLC. So you have your LLC set up. This is not uncommon. And you've been watching my videos and I've been telling you, hey, listen, one property per LLC. You're like, gosh, I made a mistake. The individual I was working with, we put 3 properties in this LLC that's taxed, of course, as an S Corp. All right, because you missed that aspect of it. And now you want to gain asset protection. You want to strip them out and put them in separate entities. So you're thinking, hey, I'm just going to create 2 other LLCs right here and here, and I'm going to move those properties over. And I'm going to own them all. Maybe you got your holding LLC set up. I'm not going to go into that in this one because that could be another issue here. You want to strip them out. Well, guess what? If you did that and you own these LLC interests, again, when you move this property out and that property out, taxable event, right? It's treated as a property sale. So now you're thinking, oh gosh, I'm stuck. I'm going to keep 3 properties in this one S Corp, and I'm not going to get the level of protection that I really want, which is to ensure that if anything goes wrong with one property, I haven't risked them all. Okay, so I can't help you with the S Corp, all right? You're going to have to stay with that S Corporation. But what we can do is fix the overall structure. And that is, we're not going to go out, okay, on the sides. We're not going to go lateral here and separate them out and have you own all these companies. Instead, we're going to go vertical. What we're going to do is we're going to create 3 LLCs up top, like this. And each of those LLCs are going to be owned by this S Corporation. So all of these will be disregarded LLCs. Okay, they're going to be disregarded. Now, what I'm going to do is I'm going to take those 3 properties and I'm going to move them out of the S Corp and I'm going to put them into these new LLCs up here. So I'll put them up here into these limited liability companies, and they're all going to be owned down by the S Corp. So now we pull them out of here and we put them up here into the disregarded LLCs. That type of transfer, no tax issues for you. Because on the S Corporation's tax return, it's still going to show these 3 properties as if it owns them because the LLCs are disregarded. So from the IRS's point of view, yeah, the S Corporation does own them. Now, if you got this S Corp here and you want some protection for it, and you're wondering how can you structure it, something that you could consider is you could have that interest held by a Wyoming LLC down here. You could set that up, and you can have your shares owned by that. But this Wyoming LLC has to be disregarded as well. So this isn't something you should even attempt on your own without consulting with a strategist who understands the nuances of using S corporations. I mean, they create problems for us all the time when we're working with real estate investors who come to us and they've already set these structures up. So we have to be a little more careful in the planning to ensure that we do not create taxable events. All right, guys, if you liked the video, give me some likes. Subscribe if you haven't. And be sure to check back next week for more great content on tax and asset protection for real estate investors.